Hey, this is JC with FX Insights at CIS Trading. Wanted to take a look at one thing that's something to be very watchful for when trading foreign exchange markets and really any market in the world. One of the challenges in trading foreign exchange markets, especially if you're trading short-term time frames, has to deal with the ability to cover. A lot of the market depth analysis tools from CIS Trading help us to sort of determine if the opportunities that we're looking at will have the market depth necessary to cover. But one problem and one challenge that you might face is when a broker or a data provider is providing any type of spread fixing that is pre-programmed. Now, what spread fixing is when the spread is fixed against the move of the position so that if the market was to move up on your offer price, once you were long that position, as the price moves up, if the bid lags, in other words, if the bid doesn't move up right away to cover, to give the market time to maybe come back before covering, especially on 1 minute time frames and 5 minute time frames. So what we're going to do is watch this pound Australian dollar trade on this 1 minute and see if you see any spread fixing in that market where when the price moves, for example, up, the bid doesn't move up to cover, or the price moves down and the ask or offer price doesn't move down to cover. If there's any lag in the spread and the spread adjusts and either gets wider or narrower against the potential move of the position, then what you have in that situation, if that spread changes and fluctuates against the move of the price in any way, for example, just then, you could see that bid lag right there. That's spread fixing. That means it is programmed at the broker. The spreads are being programmed at the broker, and they're fixing those spreads based on the direction of the price move. Do you see how we have a much wider spread as the price moves? And you have a lag in the bid as it moves up to delay the cover in case the price moves down. That's spread fixing. Someone has programmed that to do that through that particular broker. So we'll watch this just for a second as we are looking at a 1 minute chart of the pound Australian dollar in focus and see if you see those spreads adjust and widen out as the price moves or narrow against the move of the price. You notice how when that bid lags, that it eventually can cause the price to move down. Same thing on the offer side. See how the bid lagged just before that price as it moved up? That bid lagged, and then look at what happens to the price. It has a pull against the price. You see how wide the spreads have moved? That's spread fixing. Someone's fixing the spread to the movement of the price against a position in favor of the price move. See how the bid's lagging? You should see the price move down here in a moment. When that bid lags, there it goes. You see the price move down. See how the bid holds off when the price moves up, the market price? That's spread fixing. So this is one thing you need to be watchful for, because when you're trading short-term time frames, especially the 1 minute and the 5 minute, I can go right here. I'll show you a 5 minute chart. When you're trading a 1 minute and a 5 minute, especially if you're trading short-term, very active trading, there might be something happening if there's spread fixing at the broker where your opportunity to cover, even if the move moves in your favor, if the price move moves in your favor, your ability to cover can be diminished. And you can also have a situation, for example, where if you look at the net position, for example, in the pound Australian dollar, somebody's spread fixing against the up move significantly. See how when the price moves up, there's a lag in the bid and it puts pressure on the price to come down? They're spread fixing and they're affecting the market value of the pound Australian dollar. Typically, when we see that at FX Insights, it's a good indication to really leverage, see how that bid lags and it starts to pull the price down afterward. It's a good opportunity to leverage against that spread fixing. The reason why, there could be, for example, in this pound Australian dollar, when you look at it on a kind of little longer time scale there, you can see that there's been a significant move down and we see significant spread fixing as the price moves up. That puts pressure on that price. It could be that all this pressure in this pound Australian dollar is a result of spread fixing, that there's not really trading, shorting that position or capital being devalued in it in the market, that someone's doing this illegally to the actual value of the pound Australian dollar in the exchange. So once again, I'm JC with FX Insights at CIS Trading with a quick tip on spread fixing and what to watch for when you see spread fixing. For example, what we're looking at here in the pound Australian dollar. See, as the price moves up, that bid does not come in, and when it doesn't, it pulls the price down. And that means there is a broker programming the spreads against the move of the price and in favor of one direction or another. They're programming that spread.